So today we're talking about two technical indicators, MACD and PPO. Now both of these are acronyms for some classic trend following indicators. The MACD, MACD, stands for Moving Average Convergence-Divergence. This is an indicator created years ago, decades ago by Jerry Apple, who's a famous market prognosticator. He basically took and riffed on the idea of looking at moving averages, used exponential moving averages to better track trends. And the MACD is a common used technique to try to analyze and follow trends as they turn higher and lower. The PPO stands for Percent Price Oscillator, and it's an adaptation of the MACD. We're going to look at examples of both of those indicators, talk about how they're similar, and also, importantly, talk about some differences as well. Looking at the chart here, I have the chart of Tesla on the top going back for the last year, a couple moving averages, which we won't be addressing today. And then I have the MACD indicator on the first panel below, and the bottom panel is the PPO. Now, immediately, if you just look at these two series, you can see they're almost identical, and that is absolutely true. The calculations have some minor differences, but not much. What the Moving Average Convergence-Divergence indicator, the MACD indicator, what that's doing is you have this black line called the MACD line, and that is basically the difference between two exponential moving averages, the 12-day minus the 26-day exponential moving average. Don't even worry about those settings. All it's doing is looking at the difference between two moving averages and seeing when they're crossing up and down one another. You take a 9-day average of that line, which is the red line called the signal line, and now we're looking at when these two cross up and down through one another. So when the MACD line goes above 0 and then crosses below the red signal line, that's a classic sell signal. When it's going lower and then below 0, crosses up through the red signal line, that's a classic buy signal. And you can see that the buy signals and sell signals between the two indicators, again, almost identical. So what's the difference? The PPO does the same exact thing, but instead of doing the difference on absolute terms, it's doing the difference in percentage terms. So it's basically the percent difference between those two moving averages. Seems like a subtle kind of non-important difference. And if you're looking at a one-year chart, you're probably going to see identical signals. By the way, this chart right now potentially showing that Tesla is rolling over and moving to the downside. But look at what happens when I bring in way more data. If I look at like 11 years instead of 1 year, you can see that the MACD indicator basically flatlines. And that's because when we're going back here, when Tesla was way lower in price, and again, we've had adjustments on some of these data series, but you know, when the price is not in the 800s, but down in the 50s or down in the single digits, the difference between those moving averages is so minimal that basically the MACD indicator is a flat line. The percent price oscillator is based on percentages, so it's going to give you a much better reading about the trends and how they've evolved over longer periods of time. So since the indicators are identical in many ways, I tend to use the PPO instead of the MACD because it's a better way of making an apples-to-apples comparison between different time periods and especially between different stocks. If you have a number of different stocks and you're just looking at the PPO signals, chances are you're looking at a pretty similar comparison across those different charts. So by paying attention to the MACD indicator and the PPO, just looking at when those triggers are, when the MACD line or the PPO line crosses up and down through the signal line, you can get a very clear indication of when the trend is reversing higher and, more importantly, when the trend is reversing lower.